probably the most elementary, simple way to build wealth in real estate is go out and buy your first home.
Right, because it's time in the market. It's not when you get in the market, it's how much time you spend in the market. So the longer you're a homeowner, the faster and closer you are to get towards building that wealth.
All right. So, hey, everybody, this is Josh Ranchi, the Country of Real Estate here in Tehachapi, alongside with Kevin Sanderlin over at Dignified Home Loans. And,
good morning.
Good morning, Kev. How you doing today?
Doing good. Thanks. How are you?
Good. Recovering from the power outage?
Yep. I got a little sleep last night. Doing better.
Excellent. Yeah. We went out and bought a generator. Yeah, it's kind of the new norm here in parts of California. Seems like going to be some new disclosure issues that, yes, we are affected by the mandatory power outages throughout the state. So that'll be fun. That'll be fun going forward from here. We wanted to talk about today, there was a recent a piece of information that came across my email from the California Association of Realtors that they went out and did a kind of a random sampling of people who are currently renting their homes and asked them, yes or no, I think it was like a yes or no, are you required to have 20% down to purchase a home? And over half of the people that they sampled still believe that you need to have 20% down to purchase a home. And of course, you and I being in the industry and dealing with it all the time, we know that's just not true. So
right.
I wanted to kind of, bring you in as an expert lender on the issue and kind of we'll talk about a few different things, but first let's just nail, true or false, do you need 20% down to buy a home?
Yeah, it's definitely a false, definitely a myth. And I've heard that too. I've heard people think that they need 20% down to buy a home, and you definitely don't. So you can buy a home with less than 20% down for sure.
Okay, so what kind of so are we talking, 15%, 18%? What kind of numbers are we looking at?
So the first thing we look at is we're looking at a primary residence or an investment property, right? Okay. So investment property, you're looking at 15% down minimum, still less than 20%, which is pretty good for an investment property.
Didn't investment properties, weren't they pretty standard, like at 25% there for a while?
Yeah, I mean, after the 2008 recession, lending got pretty strict there for a while. So everyone wanted to see bigger down payments. But now we're 11 years later, and so lending is definitely more loose than it used to be back then.
Yeah, so, we don't like that term loose. Let's be careful. It's not super loose. It's
more flexible.
More flexible. I like that.
More flexible than we were looking at 2009, 2010, right after the recession. Now we're back into more of a normal lending market, which is very, very more easy to work with for people, especially that have less than 20% down.
Okay, so let's get kind of back more to like that renter demographic. Obviously, if they're renting, they're probably not looking at an investment property in their portfolio yet. So when it comes to primary residence, what are some of the different breakdowns on how much money you need to bring to the table?
So next, looking at the primary residence, right off the bat, when you do put down less than 20%, you're going to have something called private mortgage insurance. So the lender is taking on this extra risk. They're going to be taking on a loan with less than 20% down. So the way that they hedge against that risk is they're going to charge the borrower a little bit of private mortgage insurance. That's going to be a monthly fee, just added onto your mortgage. However, even though with that monthly fee added onto your mortgage, it's still a really great resource for buyers, especially first-time home buyers looking to buy their home. So how much down payment is needed? So we have loan programs where you're looking at 10% down, 5% down, 3.5% down, 3% down. And then we also have several loan programs with 0% down.
0% down. Now, 0% down almost sounds like one of those 3:00 in the morning scams, right? You're on TV and you hear the guy say, hey, you want to get started in real estate? I can show you how to do this with no money down.
Correct. 0 down, no money needed.
So what's a 0 down loan? What does that look like?
So first off the bat, even if it is a 0 down loan, we don't want to get into no money needed, right? So there is usually some money needed. You got to have still income, job, things like that. But you don't have to have a job. You have to have income. So you have to have some income to qualify for the loan. And if you don't have any money for the down payment, so that would be the 10, 5, 3.5, 3% down. If you're going to do a 0 down loan, that down payment's going to be covered depending on what kind of loan program we're talking about. The first thing you need to know is there's still going to be closing costs involved in this purchase. Now, closing costs can range depending on the price range, depending on the type of loan you're getting. So closing costs are going to be in the thousands. They're going to be anywhere from a few thousand to a lot of thousands, even sometimes over 10,000, depending on the price range. So you need to look at those closing costs. Then we have a couple programs that even help out with the closing costs. So if you want to just break it down to the bare minimum, how much cash is actually needed in order to buy a home, we definitely have borrowers that I have closed this year and help them get into a home with less than $500.
Wow, less than five. So that almost is like no money down.
Yeah, it can work that way if we get the right loan program for the borrower and the right price range, the right house. If everything works out right, it can be done with less than $500.
That's pretty amazing. Now, can we like briefly talk about like the importance of your FICO score, your credit score? Like, is it one of these things where you have to have super stellar credit score to find some of these programs, or is it open to a pretty broad group of people?
So generally what it looks like when you're trying to choose a program, you're going to apply for the loan first so that we can see what kind of credit scores we're working with, what kind of debt, what kind of income. Because depending on what kind of information we're looking at will tell us what's the best loan program fit for you. To give you an example, if you don't have perfect credit, we're probably going to be looking at an FHA loan.
What does FHA stand for?
Yeah, so Federal Housing Authority, it's a government national loan. It's geared towards first-time homebuyers and low to moderate income families and people, but you don't have to be a first-time homebuyer. So it's still flexible enough that a lot of people can qualify for it, and you can have not perfect credit, some credit problems, and still might be able to qualify for that FHA. So if we're looking at someone who does have some credit history that needs some work, I usually go right to the FHA. That's going to be the most generous for that type of borrower. However, if we have someone who needs to do a zero down loan, if that's absolutely necessary, then we're looking at 640 or higher for the credit score.
640 or higher. Okay.
Yeah, excellent. All of our zero down loan programs require 640 or higher credit score.
All right. Okay, that's pretty good.
Yeah.
So like every time I go to the bank, right, to put my money, a check in the bank or something like that, and and they have loan programs too, but they don't seem to be quite very, as flexible. So can you kind of explain to the people here the difference between going to a bank and then going, because you're a mortgage broker, correct? And kind of explain, like, your company's a brokerage and you have many different lenders, or some do, maybe yours doesn't, but others do have more lenders, and so they have a wider panel of products to look at, correct?
Well, kind of. I wouldn't call us a broker, actually. We are a direct lender, so that's how I would classify.
There's the third. So let's explain to people all those different things.
Yeah. So let's start. You mentioned the bank. So you walk into a bank, you say, I want to get a home loan. They're going to have more limited choices for you. Maybe conventional loans, maybe FHA, but they might not have some of these zero down programs that we have. And so we are a direct lender. We loan our own money just like a bank does, but we don't do banking. We don't have checking and savings accounts that we manage. We only do home loans. So because we're more specialized in home loans, we can offer more products, sometimes be more competitive, be more flexible in what kind of loans we can give. So the big banks are definitely a little bit more, have their hands tied with what they're able to do. And we have a little bit more flexibility. Being a direct lender, lending our own money, we can also move a lot quicker than other banks can too.
Okay.
But when you say mortgage broker, that is generally a little bit different. The term mortgage broker is used for someone who's originating loans, and then they are working with other banks. They're going to shop that loan with other banks, but the other banks are going to go ahead and fund that loan. So that mortgage broker doesn't have as much control over the transaction because they're looking at a whole bunch of other banks. They're picking one, and then they're relying on that bank's processors, that bank's underwriters the whole loan is processed outside of that originator's, capable authority to make decisions and things like that.
So is there, what's like a good example out in the real world that people would come across that's more like a broker? Is that like when you go online to Lending Tree and put in your information and then a bunch of people start calling you?
If you go on Lending Tree, you might hear from mortgage brokers or direct lenders. So,
Okay.
For the most part, everything's a little bit meshed together. A customer might not know if they're dealing with a direct lender or a mortgage broker. Obviously, if you're dealing with a bank, because you literally would be, walking into it, or it'd be a big bank. But when it comes to direct lenders and mortgage brokers, the way to tell the difference is just ask, are you lending your own money, or are you shopping it out and working with other banks? And that's the key difference between a mortgage broker and a lender. Now, as a direct lender, we do fund our own loans with our money. And then we do go ahead and sell the loan. So we sell the loan after it closes so that it's not interfering with the transaction. And then we get our money back, and then we're able to loan our money again and just turn it over and over again.
So that's like usually when you get, for those that haven't owned a home before, they wouldn't understand the process.
Right.
Usually a couple of months after you close the loan and you're in the house, you usually get a letter in the mail that says, such and such bank, or,
servicer or bank.
Servicer, exactly. Loan servicer has now taken control of your loan. You'll be paying them now instead of your
correct
company. Because that again, that's what we call the secondary market, correct? Where we sell that loan off and you guys get your money back, and that allows you to continue to make more loans.
Correct. And in today's market, most lenders are doing that.
Correct. There's only very few, correct?
Very few banks who actually want to hold on to their own portfolio, because why hang on to that portfolio when you can sell it and reloan that money again?
Absolutely. Yeah. And then, so like for somebody who's renting, right, and they feel like they're stuck in that situation, I mean, we know, because we see it all the time. Renting is typically a one-directional type of a transaction. You go out, work, you make money, you pay your landlord, and then that's it. The money just evaporates. It's gone. It goes to somebody else. And then can you kind of explain the process of why is it so important to try to get into a home, and how that it generates wealth building, which is really, really important in your financial security as you grow older, to build that wealth.
Yeah. So the first thing I ask a renter is how much is their rent. Usually it's been going up over the past 10 years or so. Rent's been going up, and when they tell me how much they're paying in rent, they kind of say, I pay this, and you can hear they don't like paying someone else's mortgage. So they say that this is what I pay in the rent. Maybe it's $1,000, $2,000 a month, whatever it is. And I say, okay, well, let's look at something real quick. Let's look at how much you're paying in rent per year. So let's say they're paying $2,000 per month in rent. Okay, well, that's $24,000 per year that you're paying towards rent, and you don't have anything to show for it in terms of savings or equity or building your wealth. So what if we were to take that same $24,000 and apply it to buying a home down, paying down a mortgage, building equity? So that's where I start with, is how much they're spending right now on their rent. And then we take that and what would that look like for a purchase? Because that $24,000 a year, that's not going to all go towards paying your principal balance down on a home mortgage. You're going to be paying a lot of interest too. However, over time, it is definitely going to pay down that principal balance more and more as time goes on.
Sure, and you have the benefit, in a rising market, which we've been in now for a while, and of course, not all markets rise; they go up, they go down. But historically, those ups and downs still lead us into a incline there. That appreciation, you don't get to discover that or benefit from that in a rental situation. Your landlord does.
Right.
That's the other big key about building wealth too, is over time, that appreciation equals equity. Equity equals money in the bank at the end of the day.
Yeah, it's going to be you're building that equity, and you're going to have if you sell the house, if you move and sell, if you leaving something to your heirs as far as a higher net worth, more flexibility you can do with equity. You can also borrow against equity. I recently took out a home equity line of credit. where I borrowed against my equity. So yeah, you have a lot more options when you are a homeowner that you don't have when you're a renter.
Absolutely. You can leverage that, right? You can leverage that money. So real quick, I didn't kind of prep you about this, but one of the things that's real important from on the state level this year is that we tell people about our home buying experiences, right? Telling our story. So, I mean, I was going to just kind of real briefly talk about when I moved back up here to Tehachapi in 2013, we found a bank foreclosure. It was an REO, right? Bank owned property. And I think we got an FHA 3% down loan. And I think it was about $11,000 total for us to get into that house, which isn't a huge amount of money. That was 3%, 3.5% down. That was the all the closing costs that were involved in that. And explain also too, when somebody does something that simple, I mean, now there is a possibility to say you don't have 11 or 12 or 13,000, and that's, can you get some of that money from a family member? And in which cases would that work? In which cases would that not work?
Right. So when you want to borrow money from a family member, those are called gift funds.
Okay.
So gift funds are what we can use to have you borrow some money from a family member, and that can help out to help the purchase. So yeah, those are definitely a huge help. When you have those, you can use them differently for different types of loans. But basically, yeah, if that's definitely one thing that if someone's just short of what they need, then yeah, sometimes I ask them, do you have any family members that you'd be able to use some gift funds from?
Yeah.
That family member would have to supply proof that they have the money to give, and then they would also have to sign a gift letter stating that they are giving the funds to this family owner.
That it's not creating an additional loan, which would then mess up your debt to income ratio, correct?
Right, and that can happen too, where someone is actually getting a loan to borrow some of the down payment. And sometimes that is a possibility as well. And then we just take that payment for that loan and add it into the debt to income ratio.
Gotcha. So for me, that was what, 6 years ago, almost 7 years ago now, and that $11,000. And being that, well, just full disclosure, Kevin is my brother-in-law, and we live here at Gatsby together. But I've rolled that 2 or 3 times now into different houses, and that original $11,000 that it took me to close that first home, which I think only about 6 was my own money. I got a $5,000 gift on that, and then we've now rolled that probably, a little over 130,000 in equity in the home that we sit in. So that's how you build wealth in this game. I mean, we can go. You and I could probably sit here and have hours worth of conversations talking about different strategies, and there's so many. I mean, real estate it's like a tree with a bazillion branches, right? There's so many different roads you can go down.
It sure is,
to build wealth. But one of I think probably the most elementary, simple way to build wealth in real estate is go out and buy your first home.
Right, because it's time in the market. It's not when you get in the market, it's how much time you spend in the market. So the longer you're a homeowner, the faster and closer you are to get towards building that wealth.
Yeah, cool. What about you? What's your big takeaway story in real estate? What is the one thing that you look back, because I know you, like me, got into real estate pretty young.
Yeah.
I think I was 18 the first time I owned something. It was, that's very unusual. And I know you were also probably pretty young.
Yeah, I was 24 when I bought my first property. It was a condo in Long Beach. And one thing I learned that I did, and I saw a lot of people do, is they would, we had the values just booming in 2001 to 2006, 2005. So the values were going up so fast. I saw so many people that would take out their equity. And for me, I was taking out equity and buying investment properties, but other people were taking out equity and buying motor homes and second homes and things like that. And so they were owning this home. The value was going up, yet they were kept borrowing more and more against their house. And so being 24 years old, I didn't see any problem with that, nor did many of my friends.
Sure.
However, now I'm just really big on paying that house down. So when someone comes to me and says, hey, should I take some equity out and remodel my house or do this or do that, I usually get them to think long-term and think, well, when do you want to pay this house off? Do you want to pay it off in 30 years or do you want to pay it off in 40 or 50 years? Or 15,
or 15 or 20 years.
15 or 20 years,
yeah,
right.
Absolutely.
So I really like the strategy of getting in a 30-year fixed loan and then paying it down for about 5 to 10 years and then refinancing into a 15-year fixed. That way you're not spending 30 years paying off your house. You're actually paying off your house in closer to 20 years.
Yeah. I mean, when you look at it, there's a lot of things that are heartbreaking about owning a home, right? When something breaks in the house, you can't call your landlord to get it fixed.
Yeah.
You have to do it.
Yeah.
But the other part that's kind of heartbreaking is when you do see that 30-year amortization table on your loan, you're like, oh my God, this $300,000 home's costing me, $650,000 over 30 years.
Yeah, there's a lot of interest. Yeah.
Yeah, there's a lot of interest in there, but again, you're still getting to enjoy all of that appreciation in the overall length. And then at that 30-year, you end up with, an asset that's probably going to be worth $400,000+ at that point in time. So
yeah,
it's still the right, it's still the right move to make. It's still the right move to make. So yeah, cool. Well, anything you want to add before we finish today's call? I appreciate you being here. Kevin Sanderlin with Dignified Home Loans here in Tehachapi. Real quick, let's just go into your local. Why is that so much better that you're local? Other than the fact that you have, like with me and with other realtors in the area, you have relationships, right? So when things get troubled and fall apart or we're having issues, you and I and you and the other realtors can talk in real time all the time, working on solutions. What are some of the other benefits?
Yeah. So being a loan officer in California, you can do loans anywhere in California. Recently, I just got a new borrower who was working with a loan officer in Los Angeles, and that loan officer hadn't ordered the appraisal yet. We were 3 weeks into escrow. 3 weeks into escrow, and the realtor says, well, why didn't you order the appraisal? It's a rural area. I like to take my time with that kind of thing. Well, they have no idea that appraisals take a lot longer here than they do in Los Angeles. In Los Angeles, you can order it on a rush and get an appraisal turnaround time as quick as a few days. Here, we have just one known appraisal in Tehachapi, appraiser. And so when you go to that appraiser and order that appraisal, he's not going to be able to hammer that out in a few days. He's going to have a waiting list. It's going to be anywhere from 1 to 2 weeks, sometimes even more than 2 weeks. Yes. So you can't just wait till
the agent's yanking their hair out.
Yeah. You can't wait till the 3rd week of escrow and order that appraisal and expect that to just turn around real quick. So I ended up picking up that loan. They ditched that lender because he didn't understand the timing of what you need to do up here. And so we put that appraisal on a rush, and we are getting it back today, actually. So
cool. And then like your particular company, you have a program, because I know that we've done some stuff before where you can get that appraisal ordered like within the first couple of days.
Yeah, right? The appraisal ordering is definitely, the appraisal can be the number one thing to hold up a transaction.
Absolutely.
Especially here where they take longer. So it was important to me that I chose a company that could process appraisals quickly, as quick as possible. So what our company did was we decided to take on a little extra risk, and we will go ahead and order that appraisal on day one. As soon as I get the contract, as long as that contract is complete, I can order that appraisal within 5 minutes. Get that appraisal ordered, get that going, and the sooner we get that back in our hands, the sooner we're going to be able to close the transaction and know that we're not going to have any issues like the appraisal coming in low or the appraiser calling out some items that need to be fixed on the house. You want to find that stuff out as soon as possible and not wait till the last minute.
Absolutely. We hate day 28, day 29, last minute rushes to get things fixed on the 30-day escrow.
Exactly.
And for the most part, the buyer and the seller in that first 17 days pretty much solidify the way that the rest of the transaction is going to go. And it's usually from like day 17 until day 30 or 40 or however long it takes. That, again, we're just waiting for that appraisal to come in.
Right.
Final underwriting process and getting it into closing. So the faster we get those appraisals done, man, it makes a huge difference. And I think, also sometimes with those out of area people, we don't know where those appraisers are coming from. We don't know what appraisal management companies they're using.
Right.
So you get guys that are driving all the way up from Los Angeles, coming up from Riverside, from gosh knows who, from where, and they don't understand the uniqueness of our market up
Right.
here. So yeah, I would say for sure when you're looking at buying home in kind of like a non-conforming area, a unique rural area that doesn't have cookie cutter developments everywhere, which is what Tehachapi, most of Tehachapi is that way.
Yeah.
The importance of going with a local lender who understands the process is huge. I mean, it's huge in the amount of stress, because this is already a hugely stressful process buying a home. Anything you can do to lower that is like gold. It's like gold.
Yeah, definitely.
Yeah. All right, Kev. Well, thanks for spending some time with us today. And
thanks for having me.
Absolutely. Yeah. So go ahead and plug yourself there if you need to. I'm
all right.
Shameless plugs. Go for
it.
No
problem. Yeah, just here. I guess the other thing I'd say is a lot of lenders are available 9 to 5, Monday through Friday. And when you're a buyer buying your first home, or whether you're buying your second or third home, a lot of stuff happens evenings and weekends. You're talking to your realtors, you're negotiating parts of the contract, you're writing offers, you're looking at homes. So, I'd say one of the other things that I take a lot of pride in is just being available evenings and weekends, because when you're buying a home, you want to have that team built around you that is going to be able to answer every question you have, walk you through everything, make sure that you understand the entire process, comfortable with the entire process. So all of that is really big on how I do business. So
absolutely. Yeah. You and I have done pre-qual letters at 10 o'clock at night.
Yep. Yeah. No problem.
Or, stuff on Saturday, stuff on Sunday all the time.
Yep.
You're on the soccer field doing your thing, get off the field and go back to the office in your cleats and hammer things out on the computer.
That's right.
Absolutely. Right. And that's the thing, right? So if realtors usually are showing people properties on Saturdays and Sundays,
right?
And sometimes in a competitive market, you can't wait an extra 24, 36, 48 hours to get you get that offer in right away.
Yeah, the buyer wants the house is ready. You don't want any other buyers to come in and swoop it up while your lender is not available. So absolutely. Very important.
All right, cool. Great advice. Great information.
All right. Thank you very much. Appreciate it.
You got it. All right. Take care.
All right. You too.
All right. Bye.